Annual inflation is rising.
Less than 2% inflation for more than the last 25 years.
Inflation is rocking American consumers.
The U.S. has reached the debt ceiling.
Of that $304 billion in debt issued at
Inflation sticker shock is hitting millions of Americans hard.
We all know that US has been in the grips of inflation worries since 2021, with inflation figures peaking at above 9% last year, which in usual standard scenario as depicted should be around 1 to 1.5%, and the fears of recession are swirling all around, with major banks predicting a recession to show up anytime in 2023. But inflation is just one of the major storms the US economy is about to face. The country is one of the most indebted nations of the world, which has more than $31 trillion of mounting debt, which alone constitutes more than 30% of the total world's debt. And this debt, while we are talking, is about to reach something known as the debt ceiling, and that too pretty fast. So if US debt ceiling is reached or worse crossed, it will bring an economic crash so huge that it will embroil the nation in a recession so bad, the likes of which the country has never ever seen, since this will lead to downgrading the country's credit rating in the global economic markets, which in turn would mean high interest costs, cutting of social security benefits, millions of people losing their jobs, and to top it all, people losing their houses they live in. So in today's episode, let's find out what is the debt ceiling issue all about, why US has so much debt, what could push the country to default on its debt for the first time ever in the nation's history, and what could be done to prevent this default, thereby preventing the incoming economic doom for the nation. Chapter 1. The Dead Conundrum. Alright. Before discussing the debt ceiling and how can it bring about the economic doom for US, it's imperative that we first understand the concept of debt. Why do nations take debt in the first place, and why is it that they are not able to pay off debt as easily? To put the definition of debt in most simplest form, it is the money the government owes to either the people of its nation, other countries or businesses. Let's say government wants to borrow money to fund some program it has introduced for the farmers of the country. So it can either use funds which it collects from taxes, or it can borrow money from the people by issuing bonds in the market, which is nothing but debt. Now, as soon as the government issues the bonds, the people buy these bonds because of two major reasons. Number one, these bonds are the safest investments for them because they are backed by the government of the nation, and thus won't pose a default risk for the investors. Number two, these bonds pay interest to the investors in the form of bond yield, or in other words, passive income. But why is it debt for the government? Well, you see, since the government is taking money from investors, it is thus liable to pay back to these investors, which is why it is a debt for the government. So investors get a yield on their bond, which is least risky investment, and the government gets money to fund the project for farmers. Win-win. Alright, but think about this. Why would the government take on debt when they have taxes to use to fund their operations, right? Well, you see, usually nations, and in this case US, have spending which exceeds the revenues collected from taxes. And when the spending exceeds taxes, which is the case most of the times, it creates a deficit. And the money so raised by issuing bonds is then used to cover the deficit and fund the government operations. So for example, if a nation, say Konoha, generates 500 rupees in year 1 and spends 1000 rupees in year 1, while it generates 600 rupees in year 2 and spends 1000 rupees in year 2, then the deficits for the respective years is 500 in year 1 and 400 in year 2. So the aggregate of these deficits, that is 900 rupees, becomes the debt for the nation of Konoha, which Konoha has borrowed from the investors. Okay, that clears things up. But why is spending necessary to be more than revenues? Why don't run a surplus, right? Or to put it another way, why do nations take up debt in the first place, and why is it necessary? To understand this, we need to understand two different scenarios which make debt a necessary instrument. In the first scenario, with the help of the debt so taken, the government increases spending, with the taxes remaining constant. So, when the spending is increased in welfare programs or infrastructural development, this would further create jobs. When people get jobs, it means either more money to spend in the market, thereby boosting demands for products, or more money to invest, which as a result leads to economic growth. In the second scenario, the government reduces taxes, keeping spending constant with the help of debt. So, reducing taxes means more money going directly in the hands of businesses and families, thus, more money to spend. This will again lead to either demand for products or growth in investment, which ultimately will drive economic growth. Hence, debt is a necessary instrument of driving economic growth for every country. But then the next question which can be asked is that since it's positive to take on debt for economic growth, so can a nation take on infinite amount of debt? At what point does the debt become risky for a nation? Well, since debt is always calculated as a percentage of GDP of a nation, so as per a World Bank study, when debt to GDP ratio exceeds 77% for a long period, it slows the economic growth by 1.7% for every percentage point of debt above it. And this can be well portrayed by Greece's example, whose debt became so large that it spiraled into default, which led to its credit rating became downgraded by rating agencies, which made the interest rates rise, thereby slowing its economy. So to sum up, a country cannot take an infinite amount of debt, and it needs to manage its debt at all times by lowering down its spending and raising the revenues. The goal should always be to lower the deficit and keep the debt to GDP ratio under the 77% range. Chapter 2. The US Debt Story. Alright, so we have cleared the air around debt and its necessity. But since we're talking about US here, so the main question to ask is then, how did a country which is considered an economic powerhouse gather up so much debt? How did its debt get so big at the first place? Let's get into story mode and follow this chart here. The US federal government, as you see here, was nearly debt free before the Civil War took place in 1860s. The war surged the public debt from 65 million in 1860s to 2.76 billion in 1866, bringing more than $2 billion of debt in one go. Then up until World War I took place, the country saw an era of high economic growth. The debt before the war accounted for just 2.7% of the GDP, which directly took a hard fall to 33%, with more than 25 billions in debt in the aftermath of the war. But the country, with its prudent mindset, adopted a combination of budget surpluses, expenditures aimed directly at paying off debt early, and payments from the losers of war, which helped it achieve significant progress in bringing down the debt. And as a result, the debt fell by more than 9 billion by 1930, a reduction of more than a third of accumulation. Then came the era of President Franklin D. Roosevelt, or FDR in short, under whose regime the size, scope, and role of government introduced sharply. FDR was the same guy who brought the oil deal with Saudi Arabia to a close and established the introduction of the petrodollars which run the oil trade today. But in the wake of fighting the Great Depression in the 1930s, preparing the country for World War II, just post the Great Depression, and investing in Saudi Arabia's oil extraction and security, the president embedded a name in the history books by piling on more than $236 billion of debt between 1933 and 1945, which was an increase of about 1048%. So historically, FDR has accumulated more debt in percentage terms than any other US president in the country's history. On the other hand, the largest deficit in amount terms thus far goes to President Barack Obama. He added $8.3 trillion to the debt, a 70% increase. That's due to the American Recovery and Investment Stimulus Package, which helped resolve the 2008 financial crisis. He also cut taxes and increased military spending in order to get the economy back on track after one of the biggest economic shocks of the modern world. And then you have the COVID pandemic, which helped our favorite president, Trump, become the second largest contributor to the debt amount wise following President Obama. President Trump added $7.8 trillion to the debt, which was almost a 40% increase. And the cherry on the cake is the President Biden has already added more than $3 trillion to the national debt since taking office in Jan 2021, which outpaces both President Obama and Trump's spending. So if you look at this from a more wide lens perspective, periods with spikes in deficits and corresponding increases in the national debt have been periods associated with war or severe economic downturn. But if you see here, today the deficits have turned into a normal scenario, which isn't being caused by periodic spikes in wartime or recession-related spending, but rather a mismatch between the spendings and the revenues, which needs to be addressed at all costs. Chapter 3. The Debt Ceiling Impasse. Coming on to the main agenda. What is the debt ceiling exactly, and what's the impasse here? The debt ceiling is a threshold to set a maximum limit for the debt which US can take on, because beyond this limit, the country cannot issue any more debt to the public and to external investors. The debt ceiling therefore acts as a limit on borrowings to pay for spending which the Congress and the President have already approved. So in a way, this debt ceiling acts as a fail-safe against the mounting debt and rings the alarm when the debt accumulated reaches close to this ceiling, which is exactly what happened on January 19, when the debt ceiling was hit and the alarm went off. Now the interesting thing to note is that this isn't the first time the debt ceiling was reached, and whenever the debt ceiling is reached, the Congress raises the ceiling further, which is why it has been raised 78 times already since 1960, with the most recent one done on December 16, 2021. So what's the big deal then? Ceiling is reached, so the Congress will raise it further, right? Wrong. You see, it's not about raising of the ceiling in actuality, but with the excessive spending which creates the situation repeatedly. So the whole impasse is that spending be cut beforehand and only then can the ceiling be raised. But what if Congress does not raise the ceiling? That's what would bring the catastrophe. Let's understand. Let's say the US Treasury has $500 cash in hand and revenue of $1,000 from taxes coming in. Now assuming the ceiling is not raised, so $500 will be exhausted to pay off the bills. And since the government is running a deficit of $1,400, $1,000 revenue will not be able to fill the $400 deficit, because of which more $400 debt will be needed to be undertaken. But as the country has already reached its debt ceiling, the government's credit worthiness will be questioned and doubted in the global financial markets, and investors would demand higher interest on debt issued by the government now. As a result, the debt ceiling will be breached. So now the government is out of cash in hand already, and on top of that has to pay higher interest on its debt, thereby creating a vicious cycle of deficit and debt, which would bring a recession to the country and impact the average American. To put this recession in perspective, as per reports from a US think tank, it could lead to 5% decline in US growth annually. It could cost 3 million people to lose their jobs. The cost of an average 30-year-old mortgage would rise by $130,000, while retirement savings for older workers could shrink by $20,000. All because the spending wasn't controlled, the debt ceiling wasn't raised or suspended, and the country defaulted on its debt obligations. And that's how dangerous the whole debt ceiling fiasco is, ladies and gentlemen. So instead of putting the economy at risk, the lawmakers should focus on a long-term plan to address the structural mismatch between spending and revenue in order to put their country on a more sustainable fiscal path. And that was the episode, ladies and gentlemen. If you liked the episode, please hit that like button below and subscribe to the channel. We'll be back with more such knowledge-filled content. See you until next time. Mindfulness signing off.